Conglomerates are supposed to be fortresses of stability. When one pillar weakens, the others absorb the shock. But in 2025, JG Summit Holdings faced the limits of this theory, revealing what happens when the fortress must prop itself up from within. The parent company collected over 19 billion pesos in dividends. Under normal circumstances, that's a strong showing, a reward for investors, a source of fresh capital, ammunition for new ventures. But 2025 was no ordinary year. While dividends flowed in, more than double that amount, over 45 billion pesos, was poured back into struggling subsidiaries. Operating activities consumed billions more. Cash came in, only to be shuttled out at staggering speed. When dividends proved insufficient, borrowing became the only remaining lever. The parent raised nearly 99 billion pesos in fresh debt, a bold move even for a conglomerate of this scale. Substantial repayments followed, yet the parent still logged over 33 billion pesos in new net cash from financing. This wasn't capital recycling, it was a scramble to replenish a battered balance sheet. The focal point, JG Summit Olefins Corporation. In 1 year, almost 97 billion pesos was funneled into this subsidiary, only for nearly 170 billion pesos to be written off as impairment. Confession that the investment's value had collapsed. It wasn't traditional growth capital, but emergency recapitalization. And as the board ordered a 2-year shutdown and signaled large-scale asset write-downs, the rescue solidified into a cautionary tale. By year-end, the consequences were undeniable. The parent's retained earnings nosedived from 166 billion to less than 9 billion pesos. Equity was left wafer-thin, the old safety net, gone. Legally, some retained earnings survived, making dividends technically permissible. Strategically, the question was stark. Should precious cash cushion shareholders or shield the company in the aftermath of crisis? The 2025 story forces a reckoning. Conglomerates provide the luxury of optionality, but they also amplify risk. In good times, a collector of dividends. In crisis, an insurer of last resort. For JG Summit, optionality turned to obligation, and financial strength revealed its vulnerability. When capital was needed most, it came at immense cost. The real lesson? A conglomerate's reputation for resilience is always conditional. The size of the remaining retained earnings, just under 9 billion pesos, is the stark measure of what can happen when one subsidiary's fall demands the resources of an entire group. In the balance between ambition and safety, 2025 was the defining test. The scars may linger long after the crisis ends.